I'm Itai. I'm the Chief Investment Officer of Equilibrium, the family office for everyone.
Cool. Itai's our resident genius. He understands investments, he understands history, and he's going to make this fun. And we're building a unique company, as Itai talked about, where we're the family office for everybody. We help people get unique allocations into private market and alternative type of investments. And if you like that type of thing, just message us. And Itai, my only feedback for you is that your mic doesn't sound the greatest. So try going a little closer.
How's that now?
I think it's a little better. Okay, Itai, give the people what they want.
Sounds good. So in the last call, we talked about a little bit of a history lesson of the US dollar, and we're gonna continue that today. So as much as I wanted to kind of give my 2 cents on what's currently happening with the US dollar today, I wanted to continue the history lesson just a little bit. So let's do duplicate slideshow. Okay. So again, we're Equilibrium, family office for everyone. Cool logo we have. So just very briefly over some current events, which will relate to some of the stuff we're going to talk about later. This is the M2 growth in money supply year over year of the United States versus China. This is going to be important for later to kind of understand credit and liquidity, etc. So we can see in 08, 09, it was actually China that grew their money supply quite rapidly, which the Chinese credit impulse had a positive impact on the world. And now the US is borrowing from the future at a much faster clip than China is. And that's triggering a pretty significant increase in valuation. We talked about this with different metrics last call. So this time I want to look at the ratio between consumer staples and consumer discretionary. So consumer staples is the kind of things you have to have, right? So think of it as anywhere from toilet paper to canned food, where discretionary is the kind of stuff you want to have. So think of a Tesla. And currently the ratio between the two has exceeded what it was during the dot-com bubble, which is interesting to note. This has obviously been triggered by a massive surge in technology companies that actually have negative earnings. They have, for the first time in history, exceeded a $1 trillion market cap. But keep in mind that even though it's about 30% higher than what it was in 2000, there's been a ton of money that has increased in the system, and that doesn't necessarily adjust correctly for the inflation.
Itai, some of the feedback is that we can't hear you. So if you need to get that closer, put on your headphones, can you do that? And everybody else, once you hear Itai going, just put some thumbs up if you can hear him, okay?
Is now a little bit better?
Thumbs up if you can hear him. Okay, I got double thumbs from Alex. I got double thumbs from Larry. Beautiful. Cool. Tori, thank you so much. We appreciate it. All right, Itai, continue.
All righty then. So again, looking at, for those that want to be a little more conservative, that I've had a bunch of questions in that aspect, given how the market's performed, consumer staples have had on average the lowest amount of drawdowns when the S&P has been gone through a 10% or greater correction. So just wanted to bring that up real quickly.
So is this just a sign then of how bullish the general market is on the current market condition?
Yeah, I mean, you can make the argument that valuations are stretched, but it's been going on for quite some time, and it's very hard to figure out when that's going to stop. But if you want to be a little more defensive, that's normally how that plays out during those market corrections. I just have had a bunch of people asking me that over the past week or so.
Cool.
All righty. Continuing on where we stopped last week, I just wanted to do a quick refresher course here on what we did touch about. I'm not going to go too deep into it. So if you're interested in the history of the US dollar and coming out of the gold standard, etc., feel free to listen to the last call. And Jeremy, you are going to get tested today.
I'm ready for it, man. I live for this. Put me on the spot.
Okay. So petrodollar system post 1974, US population not mentioned here, but about 4% of the globe, 11% of global trade, but 24% of GDP and 40 to 60% of economic activity is denominated in USD. So what is the main problem with the USD that is similar, but a little bit different from the gold standard dilemma? And Jeremy, you want to give us a little take on the Triffin Dilemma?
Yeah. So as I remember this, if I remember this last time, the world choosing to put the United States dollar as the official reserve currency of the world has basically created an artificial demand for US dollars. And in this type of situation, when the dollar's artificially high, it makes exports look more appealing because US dollars can buy more of a foreign currency. In a situation where you can buy more of a foreign currency, it tells us that we're always going to be running at a trade deficit where our imports are going to be greater than our exports. So it doesn't matter what we want to do. If we want to buy American, do stuff more like that, the US dollar is working against us.
Yeah, that's a really good way of saying it. So basically, as you said, demand for the US dollar puts the US in a constant trade deficit. And there we are since 1974, where the petrodollar system begins, US starts running in a massive deficit. So this is probably a contributor to the wealth gap in the US as American exports become less competitive. And as a result, a lot of it gets outsourced, and the trade deficit basically hurts anybody that makes a physical product. So we can see that since the beginning of petrodollar, in the early 70s, productivity has increased quite a bit, but compensation adjusted for inflation has stayed more or less flat with very minimal gains.
So even if we got manufacturing jobs back and they hadn't all gone to China, do you think we would still see a rise in compensation?
Yeah. So if manufacturing jobs would have stayed the same, they would have probably and not been outsourced, then compensation would have kept with productivity, just like before.
I understand.
So if you look here at the real GDP per capita and the median male income, just because it's an easy comparison to that time, you can see that the median income has basically stayed flat. Real GDP per capita has increased. So that's another telltale sign of that. Same thing here with the gap, not just average income, but the gap between the top percentile and the median has diverged significantly since petrodollar started, basically as a result of that trade deficit.
And for everybody too, when he talks about petrodollar, in the world, whenever somebody wants to transact for a barrel of oil, they have to go through and convert to US dollars to make that transaction. So that type of system where there's always a need for US dollars artificially increases it. So in case you just weren't sure what the petrodollar system was, just a quick refresher.
Yeah, thank you for that. So again, the petrodollar system has been self-reinforcing, right? Because countries now need dollars to buy oil. And after decades of doing that, the financing itself takes place in dollars. So now the debt is also denominated in dollars, right? And the dollar is now backed by both the oil as well as the debt, which is a super strong self-reinforcing cycle, right? Because now you have to service your debt in dollars, creates more need for dollars, et cetera. And at some point, most of these debts are not even owed to the United States, but to other countries. So China makes dollar-based loans to other developing countries, Europe, Japan, they all do the same. So this is, again, just a quick reminder of last time. So because we're running a trade deficit, countries on the other side accumulate dollar reserves over time because they sell their stuff denominated in dollars. When they accumulate enough reserve, they don't hold it in cash, but they buy treasuries. So you see a cycle forming where when the dollar increases, there's more need to service the debts, et cetera, because now the debt gets bigger in relation to the local currency. So they liquidate their treasury holdings and there's less of it. And when the dollar drops, there's more reserves that are being accumulated. And as a result, there's more foreign buying of the US Treasury. So when you hear about China owning so much US Treasury, this is the reason, is because of the trade deficit the United States runs against China. China uses those reserves and then buys US Treasuries, which holds the yuan.
Okay, got it. And Itai, just to make sure, because that was a mouthful and I kind of want to pause there. You're basically saying that, hey, when the dollar is strong, any country that has loans backed in USD all of a sudden has to pay more of their currency to acquire US dollars. And then in that situation, that forces them to go into their FX reserves and purchase more dollars, correct? Tightening. It's a form of almost quantitative tightening for them.
That's exactly right. And that's what the dollar cycle is that we mentioned last time.
Got it. And so in the periods where there's a weak dollar, their currency buys more US dollars. It's actually almost like an expansionary period. So you're kind of saying that these foreign sectors, emerging markets kind of are working slightly inverse. Is that fair to say?
To a degree, yeah. They still need economic growth from the US, but there's a lot of incentives to keep the dollar in a stable declining trajectory. So we'll touch about that.
Cool. And we'll go on a little bit and we'll take some questions, okay? Because I know it's a lot of high level concepts.
For sure. Okay, so how does the dollar cycle turn? There are basically three major bull cycles, which caused a big reduction in the amount of treasury, just like we've seen in this chart. So what happens eventually is, as the dollar becomes too strong, foreign nations don't buy the federal debt anymore because they need the dollars to service their increasing dollar debt, right? So they don't have reserve to pay for it, which causes the Federal Reserve to eventually buy treasuries in a form of QE, which eventually weakens the dollar. And then the cycle has basically happened this way 3 different times. And I want to talk about it because each one was a little bit different. And here again, we see profits, right? So when the dollar goes lower, there's more consumption in the US. Foreign countries create cheaper exports. They boom as well because of the manufacturing, et cetera. So corporate profits have basically flattened out during periods of strong dollar and surged during periods of weak dollar, et cetera.
Got it.
So,
Itai, do you want to pause and take some questions there real quick?
Sure. And this is, by the way, this is all stuff from last time. So I just want to cover it a little bit faster.
So just real quick, Itai, so at what point does China reverse course from what they're doing right now with the US dollar and treasuries?
Possibly sooner than later. This is stuff of later stage.
And so the type of investment to put on if you think that they're about to pull the trigger.
Yeah, there are multiple implications to that. I think there's currency plays, there's interest rate plays, there's a lot of different things to put on, commodity plays. But I think we need to first understand kind of the high level of how and what would trigger that.
Okay. Cool. And we have a question about, do we see any harbinger for us to lose the USD dominance? I think that's something we'll cover a little later. Is that fair to say?
Yeah, I kind of wanted to cover a little bit of the background and history before we get into all that, because I think it's important to understand what moves this cycle before we can speculate on how it ends.
So basically all of us, everybody in the audience wants to cut to the chase, but they're going to have to wait it out. You're going to wait it out. You'll find out though. Okay.
Yes, exactly. So I'll cover it a little bit faster.
Go for it.
Okay. So I'll just skip on this part. We talked about it. All right, let's talk about the 1980s dollar cycle real quick. So 1980s on the top, you see the treasury rates started the 1980s with 13%, all the way up to 16% for the 10-year treasury. I think mortgages were around 20%. So this is a period of time we're not very familiar with today. And at the same time, you see the dollar rising from 1980 through 1985, pretty massive increase. Can you spot those three?
I see Gecko, I see Reagan, and I don't know, some other old white guy missing hair.
Okay. Head of the Fed. So very quickly, the dollar was weak in the 70s after going off the gold standard. And during that time, there was a heavy inflationary period as a result of going into fiat. In the 1980s, the new Fed chair, Paul Volcker, wanted to tame inflation. That's that bold guy. And he basically jacked interest rates significantly. But at the same time, Ronald Reagan got voted in, and the government was actually running large fiscal deficits. They were cutting taxes and they were increasing spending. So this is a weird mix, a time where you had very tight monetary policy with the Fed, but very loose monetary policy, very loose fiscal policy with the government, right? So that actually created a big, big boon for the dollar. And that's actually the opposite of what we're seeing today, where we're seeing loose monetary and fiscal policy. So the dollar soars because of this a crisis that hits Latin America. You talked about that a little bit earlier, where emerging markets during periods of growth, their economies look really, really good. When the dollar falls, they take a ton of dollar-denominated debt. The majority of their commodities that they're exporting are denominated in dollars as well. So they take all these dollar-backed loans. And what happens is, as the dollar strengthens, the loans become more difficult to pay back. So in the 1980s, there was a massive crisis in Latin America where the debt that had to be repaid was about 50% the size of GDP. And there was just a wave of defaults and currency crisis.
Got it. And then when they default, they go to USD for safety, right?
That's right. So the dollar totally surged during that time. Then in 1985, they're actually debts in the US were very, very low on a relative basis, because interest rates were really, really high, 12 to 15%. You're not going to borrow money where rates are high. It's pointless. Like, think about it, 15%, it's kind of like having credit card debt, right? So that creates a situation where debt is just low. And in 1985, Germany, Japan, the UK, and France decide, look, we want to weaken the dollar. They actually had an accord called the Plaza Accord. And the main reason was Japanese exports were extremely competitive in the world. Japan was the China of the time. And Europe and the US just wanted to compete against that. So they decided they're going to weaken the dollar together. And as a result, the dollar started to fall into the mid 80s, into the late 80s. Versus the Japanese yen. A ton of money flooded into Japan, and that contributed to a really famous asset bubble in Japan. And if anybody has ever seen this chart before, I've heard that real estate never goes down. Well, I suggest looking at Tokyo real estate over the period of 1980 through 2010, where it was essentially flat, with a 5xer between 1985 and 1990.
I love seeing the people in the audience just smiling as they see that.
Right. So let's talk about the 90s, 2000s real quick. So the Soviet Union collapses in 1991. Basically, the US is the sole superpower. And US goes in recession, declining rates as a result of it. Dollar was weak overall. Emerging markets were fairly strong. Again, that inverse correlation. And then mid-90s through 2000, the dot-com boom starts, and US starts raising interest rates, the dollar goes up again. But also, very importantly, the baby boom generation reaches their peak working years around age 40 and results in the highest labor force participation in US history. You can see that here, the labor force participation rate. Look what it was between 1990 and 2000 versus today. Now that's actually post-COVID. But at the same time, the velocity of money. Velocity of money is this idea of, when I pay something with $100, let's say I go to the restaurant and I give the restaurant $100. Let's say the restaurant owner gets to keep $70 of it. And then he goes, and how many times that same $100 circulates in the economy? So velocity was very, very high in the late 90s to 2000, almost at 2.2. So not an accident that this was the period of a surplus as well with the US budget.
Itai, just super quick. Velocity of money used to be actually important for kind of predicting how markets would respond. Why was it so important, and why is it not as relevant nowadays?
Yeah, before, and this is an interesting exercise. If anybody wants to go to the Federal Reserve of St. Louis website, all this information is publicly available. You can put velocity of M2 money supply and correlate it to the S&P 500. You will find that up until 2008, that was very correlated with the movements of the stock market. following 0809, the correlation broke between velocity of money in the stock market, and the correlation picked up between the balance sheet of the Federal Reserve and the stock market. So the liquidity that's driving the market doesn't come anymore from an aggregate of actual consumption, et cetera, but more from central bank actions.
Got it. And Gopi's got a question. I don't know if he's on, if he wants to ask it out loud.
Hi, Jeremy.
Hey, how's it going?
Hi, good. Great to meet you. I love it. First time here.
Welcome.
I am enjoying it so far. Thank you. Thanks to Larry. He's my Boston University alum. So I was wondering if the reason velocity is important because M2 only represents the volume.
Well, I think the velocity of money just represents more or less, you would see it correlates fairly well with the labor force participation rate. So there's just more money. It just shows you the amount of money and liquidity going in the real economy.
Right. So thank you. I was wondering, when people say M1, M2 money supply, does it inherently represent the velocity? Or
no. So those are two different things. So M1 and M2 is a way to measure the money stock. M1 is the most narrow definition of money supply, which is more like actual cash in the economy. M2 is a broader definition of the money supply, which represents money in saving and checking account and things like that. And then there's even broader definitions. So it's just a way of defining how much money is circulating in the economy or how much money exists.
So more velocity, the better, because more people are trading.
Yeah, more velocity just means a hotter economy. So, for example, you've seen this
more transactions
for a long period of time.
Yeah, more transactions.
For a long period of time, everybody's wondering, why isn't inflation picking up and things like that, and that's more related to velocity. But also, as you have more money out there, it's more difficult to have the same velocity of money versus the quantity of money, if that makes sense. So there's a lot of factors into it.
Okay, thank you.
Cool. Sorry for getting us off course, and thank you for the question. Itai, keep rolling.
Yeah, sounds good. Okay, so let's talk about the tech boom real quick in the 90s then. So by the second half of the 1990s, we enter the well-known tech bubble, and emerging markets at the same time as money is funneling into the US because it's chasing the NASDAQ, and also rates are a little bit higher, so there's safe money going into the US as well. Emerging markets started getting a crisis. So do you see a theme here? Every time the dollar gets into an uptick, some kind of emerging economy gets into a crisis mode. So this time it hurts the Asian countries. There's a very famous collapse of the Thai baht, followed by a default of Russia in 1998. This actually is what caused the bankruptcy of Long-Term Capital Management, a very famous hedge fund at this time. Their models did not predict this. So emerging economy markets basically had a very similar thing that happened to the Latin American countries in the 1980s. And the reason that some do better than others has to do with just the amount of dollar debt that they have relative to the amount of FX reserves that they have. So the most vulnerable nations would be those that have a lot of debt in dollars, but low reserves. So a lot of hedge funds were able to make good money in the 1990s, essentially betting against those countries' currencies and selling short their currencies in the markets. Okay, so you can see that chart again. Period of the strong dollar here we talked about, 95 2000. S&P is doing much better than the emerging markets. 2000 through 2010, the emerging markets outperformed the S&P. And we've been in a period of S&P outperformance versus emerging markets in the last 10 years. So if you want to figure out what emerging markets are going to do relative to the S&P, and I know we have some audience from countries like that, you have to figure out what the dollar is going to do, and that's going to help you quite a bit trading emerging markets.
Cool. Thank you.
So the tech busts, and when the NASDAQ bubble busts in 2000, that actually led to that EM boom we talked about, because the Fed cut rates, the dollar starts weakening, and the emergence of the so-called BRIC nations is a result of that weak dollar cycle, 2000 to 2010. So Brazil, Russia, India, China become a global force at that time. So talk about the 2010s into where we are now. The dollar was weak for a while because of massive quantitative easing programs coming out of 2008. And in 2014, the Fed started tapering quantitative easing and kind of stopping that and stopping what they were doing. And the markets was already pricing that in with a taper tantrum in 2013 and onwards. So 2014, 2015, the dollar starts rising very, very quickly. The euro went from something like 1.6 to 1.1, 1.05. And that resulted in another major bull cycle. And again, some emerging countries went into a severe recession. So the first sign of something happening with the dollar, emerging economies start suffering and going into a recession. We see that here with the inverse correlation between the dollar and the emerging markets. So 2016, the G20 meets in Shanghai. Some conspiracy theorists say there was actually another accord similar to the Plaza Accord to actually weaken the dollar to support the emerging markets. That is remained to be seen. And the Fed in 2018 actually starts quantitative tightening. So the Fed tried to see, it was actually an experiment trying to reduce the balance sheet. We keep hearing about QE all the time, but it's important to know what the Fed does because the Fed obviously impacts the value of the economy, the dollar, real estate, all asset classes are driven by Fed policy. So the Fed experiments with quantitative tightening in 2018. And from the peak to the trough, the dollar has only dropped 12%. It didn't go into one of these massive 40% declines like the previous two cycles, right? And by mid-2018, global growth slows down to the point where it's pretty evident we're still in a strong dollar period. And the emerging market victims of the time were Argentina and Turkey. They were more vulnerable and they had massive currency crises. So the Fed goes back to QE and around 2019 in midsummer. They actually didn't say that they're doing QE directly, but what their actions were very similar to QE. So in September, this is a pretty big deal. The overnight lending crisis spiked massively, and the Fed had to supply repo liquidity. So it's repurchase agreements. So a lot of companies, they don't hold actual cash, they hold T-bills. And they require lending against those T-bills for overnight liquidity purposes. And those markets were freezing significantly. So the way I view it is the Fed was experimenting with its ability to normalize the policy or basically go back to the balance sheet it had prior to 08, 09. And in 2018, they were experimenting and trying to see, can we do this? Can we do this tightening? Can we actually reduce the amount of dollars in circulation by reversing QE programs? And what happened is not only did the dollar strengthen massively, but also the repo market went into complete chaos, which caused very little disruption to the market because the Fed already flooded the repo markets with billions in new QE in 2019. So this is here, the repo markets literally go up to almost 8% overnight for a short period of time.
Itai, you said a mouthful. Do you want to pause here real quick? We can just take some questions.
Yeah.
Essentially, I think the Japanese central bank used all these strategies, macroeconomic policies. We thought at that time that the US think tanks thought they were outliers, but I think they are becoming a normal these days. Buying equities and corporate debts.
I think you are correct. So this is basically very close to modern monetary theory. What's happening right now, and they've tried to normalize. Essentially, they've realized they can't. And the only way forward is essentially doing more of what Japan has done. And I think one of the issues is it didn't really help Japan much, right? But I think you reach an endpoint where the debt amount just becomes too big. But we'll talk about that.
I had a question just about this overnight repo rate. I remember when this was happening. Has that ceased at that level, and what's kind of causing that not to happen anymore?
Yeah, the Fed just flooded it with an insane amount of liquidity into the overnight repo market, just a blank check with unlimited dollars, and it just normalized that market.
Was this a bank-to-bank loans?
Yeah, primarily.
I know there was some scare as to banks are racking up such high interest rate overnight. Yeah, obviously there's an issue there. So.
Yeah, there was just no liquidity into that in the system because the Fed was just doing QT at the time, and that's the first thing that broke.
Cool. Thank you, Rob. Thank you, everybody, for asking questions.
All right, so let's jump into COVID. So COVID hits early 2020, halts global trade completely, and oil prices actually go negative, completely collapse. There's no demand for anything. So as a result, the dollar spikes. So now we understand why the dollar goes up when these things happen, right? Everybody gets a margin call because all the debts are denominated in non-US dollars. So as a result, in US dollars. So as a result, global trade collapse, profits collapse, your debt gets bigger. You need all the dollars you can have, and demand for the dollar goes up. So the treasury market became highly liquid because foreign holders of treasuries, we talked about it, dollar reserves are held in treasuries. They need to be liquidated so they can serve as dollar-based debts. So they become totally liquid. The Fed actually says that the treasury market was not functioning effectively. So that's just so we understand what happened in March of 2020. So immediately in response to what was going on in the market, and this is like day after day, the S&P 500 gets halted, trading gets halted, everything drops, markets drop 10% in a day, and all these things are happening. And in response, the Fed cuts rates to zero and started the most massive quantitative easing program ever seen. And at the same time, unlike the 1980s that caused the strong dollar, the government also goes in pretty significant fiscal stimulus. And now we're getting more of it with the $1.9 trillion. So that causes the dollar to peak out and weaken again. And now it kind of remains to be seen what the next chapter is. So here is the reaction to that repo market to answer your question. The Fed was not holding T-bills before on the very short duration. And in response to that repo rate, they just immediately flooded the market with 300 billion of it. And here's this massive reaction. This is the reaction in 0809. Basically, the Fed goes from holding very few to injecting $2 trillion into the economy. And this is that quantitative tightening I was referring to, that very small decrease in the balance sheet. And then we go from holding 3.5 trillion to 7.5 trillion within an extremely short period of time. And again, here's the performance of the dollar in 2020. We have this massive move up with the global margin call, and then a steady decline since.
Got it. So
I've just got a quick question for Itay. When nations like Germany and other nations have to pay back their debt and they come to the end of their process, like Germany in the 20s, that inflated their currency to pay off all their debts, what are going to be kind of the first signs that we're going to see that the Fed has lost control and is going to go that, and the government's going to go that way to pay off all the debt?
I think you'll see that. I think you'll see that in the interest rate market first, and then before you see it in the currency market.
So you'll see a rise in the interest rates because people are not having it anymore.
Well, foreigners would just sell their treasuries on a massive enough rate that the Fed cannot buy it all. The treasury market becomes illiquid, and it causes a financial panic. That's probably the way you would see it. I would imagine.
Do we know the totals of how much foreign sovereign nations hold of U.S. treasuries in total?
Yes, and it's actually becoming smaller and smaller and smaller, just because the Fed is replacing them by just buying all those treasuries and issuing new treasuries. So it's not as important as it used to be, but I don't know the exact figure. I think it's around 20% now.
Okay.
The foreign governments also wants to hold US treasuries so they can use it as a leverage to influence the US government, right? If they have significant enough treasuries in their balance sheet.
I mean, that's something that I think there's a part that's a geopolitical reason that's a part of it. But at the same time, I think it's more about the fact that because the US provides the global reserve currency and it creates a trade deficit because there's more demand for dollars out there than there are dollars, than just the US domestic need for dollars. And as a result, foreign countries build a dollar reserve because they sell stuff to the US, their exporters export stuff to the US, and then they just can't hold it in cash. They just need to hold it in USD reserve. So they do it with treasuries. That's the main reason. But you know, they're having more options now. They're trying to move away from the dollar as a result of this massive increase in dollar liquidity. So we'll
are we gonna talk about that at some point in this call? Okay, cool.
Definitely.
Keep rolling.
Quick question on this. Sorry, if the Fed is buying up all the debt and is bloating its balance sheet, what's to keep it from just writing the debt off if we're concerned about debt to GDP ratios or something like that?
I think the main thing is a massive blow to the U.S. economic system. You know, because you associate those kind of things with Argentina or Turkey. The U.S. has held, you know, a reputation of being an extremely stable economy and stable country, and if you do something like that, I think it destroys the Fed's credibility in an unrepairable type of way.
Yeah, in fiat currency, trust is the most important thing.
Because there's nothing that backs it. Well, in the dollar case, oil is backing the dollar. That's the real backer, right? So it does have some commodity backing it. But it's still a fiat currency that you can produce more than there is oil. So you need to have trust in the system for it to work.
Also, go ahead.
I was just going to say, when you lose trust, if you want an example of that, talk to Jeremy's 3 ex-girlfriends, then you'll find out what happens when you lose trust.
Oh boy, way to throw me under the bus there.
Also, Itai, other commodities also traded in USD, right? Not just oil.
Yes, it's oil. It started with oil. It's the main commodity, but you know, copper, gold, like all those things are traded in USD.
And lastly, I think some parts of the world are tired that we use USD as a financial weapon in terms of sanctions and getting other nations what we want them to do.
That's a part of it that I'm going to talk about.
Okay, thank you.
Not a problem. So the current problems, let's just talk about, we talked about how the system is, and we talked about the history of the dollar system. And let's just talk about what the problems are with the current petrodollar system. So for Bretton Woods, the key flaw was there were persistent reduction in the amount of gold reserves because, you know, there was dollar convertibility for gold, and eventually other nations picked up that the US is essentially creating more money than it has the gold to back for it, and kept converting the dollar for gold to the point that Nixon had to drop the gold standard just because the gold reserves were dropping too fast. So the problem with the petrodollar system is the consistent trade deficit, right? So the trade deficit becomes so problematic over time that it caused the US to outsource very large portions of its industrial base. We talked about that. And in the process, you're creating a deficit in the net international investment position. And I'll explain what that is in a second. So the foreign sector, just as a result, owns more and more share of the US assets. So you mentioned the treasuries. That's one part of it. You get reserves in dollars, you keep the majority of them in treasuries. But as the yield goes lower and lower, it's become more and more common to use those dollar reserves to just start buying other US assets. And it creates a situation where the foreigners just keep owning larger and larger and larger portion of the US economy. And you can see that in the following graph here. So here is the international investment portion. So US liabilities versus US assets and the total net difference between them. So I know this is a concept that's important to understand, but basically, again, it's the accumulated value of the US owned financial assets in other countries versus what other countries own in the US. Because again, the foreigners end up with more dollar reserves, and then over time they invested in the US. So there's a net difference now of $15 trillion when it comes to that. So that just means that foreign countries own a much greater share of stuff in the US. And that's a direct result of the petrodollar system. Questions on that concept?
As you're thinking about it, you've now had a chance to kind of do two of these things. Do you think it would have been better for the US to never even go the route of being the reserve currency of the world?
It's a good question. Depends for who, right? There are different incentives for different groups. It's a large country.
Also, I think the US built the financial infrastructure with US dollars. So US based companies and financial institutions reap the benefit in terms of making money.
And they do.
Got it. Cool. Keep going, Itai.
All right. So the petrodollar made a lot of sense in the 1970s, right? The US was actually the largest economy in the world, and it was also the biggest importer of commodities. The USD was the only currency in the entire world that was big enough to trade oil with on a global scale. But the problem is that China is actually now the biggest importer of commodity in the world. It's actually importing more commodities than the United States. And it's very challenging to have a system that oil and most commodities are priced in USD, where the biggest trading partner is actually not the US. And at the same time, US is shrinking. The portion of the US economy as a percentage of global GDP is actually shrinking. Not that the US economy is shrinking, but the world is catching up faster. And at this time, China is in no way, shape, or form can replace the US as the holder of the sole reserve currency. Actually, no country probably can. In the aftermath of World War II, US was over 40% of global GDP. But today, the US, if you account for real consumption, not USD, with the USD, because the US GDP is measured in dollars, it's a little bit bigger. It's around 22%. But being 15 to 20% of global GDP is not enough to maintain this system indefinitely, which creates these problems. The US was able to do it for decades because it was in a very, very unique position post-World War II. And you can see it now. These USD spikes actually caused an increase in global GDP as a percentage of the world, but it's been a downtrend all the way since World War II. And now the US accounts for 24% in terms of GDP, but around 15% in terms of actual consumption. So the system is actually already starting to fray. For example, 6 years ago, Russian exports to China were 98% dollar-based, but as of 2020, it's only 33% dollar-based, 50% euro-based, believe it or not, and 17% using their own currencies. And
so, Itai, how are they able to do this? They are building their own, for example, the infrastructure, the underlying.
They have their own system. They're not using the SWIFT system. They're not using FedWire. They're not using SWIFT. They've invested the last few years literally creating their own systems to do just this.
And is that technically in violation of the world contract?
It is, which is becoming more and more frequent.
So then why do you think we don't see the United States government stepping in?
So it's different when Russia and China do it versus other countries, right? So we'll talk about that.
Okay, so, cool. I'm not going to ask anymore.
Russia's exports are significantly energy-based. So that makes it even worse, right? Because Russia does export commodities and oil. That's supposed to be the heart of the USD system. And it also exports it to Europe in more and more euro-denominated trade. So Russia is also pushing to do it with India. They were able to drop from nearly 100% of exports to just 20% of exports denominated in dollars. So you can see what happened. This is the Russian exports. You can see the dollar share. And there was a very intentional effort to drop the amount of dollar exports of Russia. And now predominantly in euro. And you can see that with India as well. Look at the US dollar exports to India versus actually ruble, which is now nearly 80%. So the Russians were able to convince the Indians to do that as well. So
why does India go along with it if the ruble has been relatively unstable?
I think a part of it is because the ruble was so cheap at the time, and buying oil in rubles was much more affordable than buying oil in dollars.
Also, it's a minor thing. You know, I'm originally from South India. When I was in high school, there was so much propaganda about Soviet Union at that time. A lot of my classmates went to Moscow for studies, not to US. There seemed to be some sentimental relationship. I mean, I'm not saying that that's a driver, but that could be also playing a part.
Thanks for the comment.
Yeah, thank you.
So this is a little bit, just something to think about that happened in the past. You asked, well, why are we letting Russia and China do that? For example, in 2000, Saddam Hussein started selling oil in the euro, which was just created. 2 years later, the US invaded Iraq and he's no longer there. Turns out there was no weapons of mass destruction there. It's disputed to what extent was that decision factored into the US decision to enter the war. But just think about it. There's a lot of dictators out there, and all of them sell their oil and commodities in US dollars. Saddam Hussein was the only small country dictator that decided not to.
Is Venezuela able to sell anything these days to China, I guess?
In USD.
They created that
They're trying to
crypto.
create their own cryptocurrency to
Right.
circumvent that. Yeah, correct.
Okay, thank you.
Which may explain the following: United States military spending versus the rest of the world. I guess the largest nations in the world combined.
That's crazy.
I guess this is essential. I don't know. So I'm just throwing a wild question. We can talk later. Is there any analogy? I wonder how Roman Empire lasted for 500 years. Did they control with economic dominance and currency, or pure military power? Is there any analogy?
Both. And they also diluted the value of their dinar for the last 500 years of their existence, where the Roman coins used to be all gold, and 500 years later, there were 1% gold and 99% copper. There's actual charts that show that. But that's a different discussion. Yeah.
Okay. Thank you.
Okay. So the problem is the US actually can't intervene with the military against major powers. Like when you can't do against Iraq what you would do against China and Russia or India. And what the US has been trying to do is sanctions. So for example, Nord Stream 2 pipeline from Russia to Germany allows Russia to export natural gas to Germany directly and do so in euros, which is what they have been doing. The United States did not like that at all. This was a Bloomberg article. They call it a crushing and potentially fatal legal and economic sanctions against Germany. This was not too long ago. And that's an article from Bloomberg. There was actually just really not too long ago where the US wanted to sanction companies doing business in Germany as a result of trying to circumvent the petrodollar. So I want to talk about the plan China has, but I think this will be the end of this call. We'll have to finish it on the next time because we are up to the hour. But this is all a part of China's plans to derail the petrodollar system. This map here shows all the Chinese infrastructure plays around the world. Many of them actually were dominated in US dollar. And that's a part of their long-term, they have very long-term plans to eventually be able to replace the dollar.
Very interesting. Well, how does this map overlay with the US infrastructure projects that are happening internationally?
Nothing even close. But we'll talk about it the next time. I have to leave some suspense.
Itai, darn it! You got to keep us all on a cliffhangers. I'm seeing this. I'm seeing a lot of people are just wanting to get right into this new segment. Anyways, well, Itai has finished this, but it's all open to questions now. We field questions on everything, so this is a great time to ask him anything you want.
All right.
All right, cool.
Hey, I have a question. Itai, hi, it's Diego.
Hey, Diego, how are you?
Fine. The reason why China is importing so much commodities, does it also have to do with their, I mean, everything is tied, like globalization wise, and China, like one of they export a lot. So part of the fact that they're importing a lot of commodities is mostly for producing or manufacturing for export. So they're all tied together. So I don't know, like, how would they become less dependent on the US dollar? Like, what would trigger it? I mean, and maybe this is for the second part, but I'm not very clear as to if they could really break away from that.
Well, if they had the ability to buy their commodities not in US dollar, that will be very beneficial for them. And maybe owning a ton of the world's infrastructure and forcing a lot of these exporting countries to do so has something to do with it. And I'm just speculating and connecting the dots.
Yeah, no, for sure.
Well, Gopi, I know you have a question. Go for it, man.
I'm sorry. I wasn't sure whether I can open my mouth.
No, you're all good. Your questions were fantastic.
Thank you. Itai, I think that also connects with the Silk Road initiative. That's the world dominance they are hoping for, right?
Yeah, the map you've seen on that last slide was primarily the Silk Road initiative plus all other infrastructure plays around the world. And
they're giving, I think, like you said, I don't know, it's a cheap money, but they're giving money to all the countries along those Silk Road, and a lot of countries are realizing after the fact that they may get into the mess.
Yep.
There's actually a good documentary for anybody that's kind of curious to see the size and scale of some of these infrastructure projects. I was watching the new Silk Road, which is on Amazon Prime, and I only got a few episodes in, but it'll give you kind of a sense of some of the things that are happening around the world with China building this Silk Road.
Thank you.
Hey, and then Itai, I just had one question for you. You had mentioned that China is switching away from the US dollar in terms of exporting or importing, and you had said that they're switching to a cryptocurrency. Can you touch on that more?
That was Venezuela, not China.
Not China, Venezuela.
Well, China actually has like a digital yuan that they've experimented with after the Wuhan stuff and all that. They've given money to people. I think I talked about it a month ago. They were giving money to people and using a digital yuan to make payments and stuff like that. But Venezuela is trying to create their own like gold, oil-backed cryptocurrency to export as well.
Thanks.
But by the way, I mean, I can tell you guys firsthand from my last company, we met a number of times with government officials from like island nations. We met with Shell Energy, as what I was telling Juliana. We met with a lot of these companies who are like, what would it look like if we tokenize things like carbon credits or our national currency? And there's actually a company I'm advising, which is actually working on this right now, where there's actually, there's multiple island nations like adopting cryptocurrencies. And so that this is something like basically it's worth knowing that this is a real trend, meaning there are, central government digital currencies is like a major trend that we're seeing take place kind of in real time in this decade. But an interesting thing to think about, by the way, that I'll put out there is that like, what happens when these multinational corporations, which are larger than any one government, like a Facebook or an Amazon, you know, we already saw this happen with Facebook, and when they launched or when they announced their cryptocurrency, the reason why there was such a backlash is because imagine if there's a Facebook coin and they control the monetary and fiscal policy of this coin. It's like, the thing is like these conglomerates like now have a deeper relationship and, you know, better distribution than like any single government in the world. And so the governments obviously are freaking out because that's what happens when, you know, they see a threat to their true monopolization of you know, the financial ecosystem. It really comes back to currencies and how they move and who controls them. So, you know, it's worth pointing out, it's not a coincidence that like Zuckerberg was pulled in front of Congress almost immediately, even though their product was half-baked and made no sense, because that's how seriously the U.S. government sees, you know, something like Facebook issuing their own currency as a threat to the, you know, global U.S. dollar, you know, dominance. I mean, it's pretty wild, but this is the intersection of tech and governance.
Itai, just one other thing. I think Tina's on. She had a question. Tina, if you're there, do you feel comfortable to ask it?
Yeah, sure. I was just kind of pulling on this crypto thread. I'm just curious how you think about non-sovereign cryptocurrencies and where it stands to, I guess, take away from the pie of either US or China or whoever else it is.
Yeah, it's a good point. So let me actually show you this, that we talked about it on a couple months ago. So there are different types of digital currencies in the world today. This is basically backed by who is it backed by, right? So the issuer is very different. Central bank dominated account base, not digital, right? Is just the reserves. Token based, which doesn't really exist today, it exists in China somewhat. The US doesn't have this yet. Other countries are working on a digital version, a token version of their currency, sovereign currency. And the physical equivalent would just be the banknote, like the actual cash. Commercial bank account base would be just bank deposits. The digital will be, you know, like what they're working on, JPM currency, whatever. Private backed, like Alipay, stablecoin, the physical equivalent is prepaid. And backed by nothing is something like a cryptocurrency or Bitcoin. The physical version is gold. So you can say, yes, there's competition for capital, but I think the majority still sees it as an investment of sorts, just like gold, and not actual money like a central bank backed digital currency, which is something we're talking about. Because you know, it's not saying it's impossible, but it's pretty far-fetched to imagine, you know, global commodities trade taking place in Bitcoin.